Hello and welcome to this special program. I'm sitting down with someone who is was regarded as one of the world's foremost equity strategists. I'm sitting down with Christopher Wood at Jefferies, and what a day to sit down with him from the sidelines of the Jefferies Investor Conference here in Gurgaon. Chris, great to have you with us here. Thank you very much for your time. I said what a day to sit down with you because we're sort of coming out of this 50 basis point rate cut from last night. What do you make of it? I know you were expecting 25, but here we've got 50.
No, I'm genuinely surprised by the size of the rate cut because it's contrary to the messaging of the Fed going into the meeting, which is that the economy is okay and the employment market is weakening, but only gradually. So, yeah, if you talked to me yesterday, I would have said 25 basis points. I think there was an article in the Wall Street Journal suggesting it might be 50 at the weekend. So that was probably the clue that they were going to go bigger. But bottom line is contrary to the messaging going in. But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3.5 by the middle of next year. But in terms of the short term, I'm surprised I'm surprised it's 50 basis points.
Do you think it's got a political angle to it as well, with elections in November?
My guess, given the fact that whatever they might argue today is quite anybody who can read and listen is contrary to the messaging going into the meeting. So my guess at the margin is political, because it's pretty clear that probably the vast majority of members of the Fed would prefer Donald Trump not being elected.
I see. And
I'm sure the Republican candidate will view it as political.
But does it help at the margin?
Maybe. I'm not sure it does help. Maybe at the margin.
Okay. I want to come back to the U.S. political sort of elections season in just a bit. But we don't see 50 basis point cuts without a crisis. Either very apparent or, I mean, something which they're worried about. But
there could be conspiracy theories that they know something and the economy is much weaker than which is a risk of them cutting 50 basis points yesterday, actually. But my guess is they actually genuinely believe the economy is okay. So that's why I think the motivating factor is political. And there clearly are some members of the Fed who are very political. Their former New York chairman, Bill Dudley, has been calling aggressively for a 50 basis point rate cut. If I remember correctly, he was the guy who once wrote an article calling on the Fed to manage monetary policy in a way that could stop President Trump being re-elected in the previous election. So I think there have been quite a lot of people calling aggressively for rate cuts, saying the Fed's behind the curve. But that's not the message transmitted by the Fed chairman, Mr. Powell. Yep.
Do you believe the economy is solid?
I believe the economy is obviously the economy is okay right now, but I still believe there is a risk of a US downturn because of the big lags in monetary tightening in this cycle. So if you look at a chart in my presentation I gave this week, there's a chart of M2 nominal GDP growth, which had a huge explosion back in 2020 when they printed all that money in the pandemic. And actually, while M2 growth has slowed sharply in the intervening period, while the Fed has been tightening, if you draw a trend line from 1997, the M2 to nominal GDP ratio has only just gone below the trend line, which is a long-winded way of saying that in liquidity terms, the monetary tightening is only just beginning to bite. And you know, the labour market is weakening. All we need for the Fed to be cutting 50 basis points every meeting is one unambiguously bad labour market
data.
Yeah.
And you get another 50.
Yeah, but then the market will be discounting 50 basis points every meeting.
Okay. The Fed themselves in the dot plot is saying that there'll be two more 25 right, this year in 2024. At this point, that seems likely. I think it'll be more than that.
Yeah, but I don't really pay any attention to the dot plots. What's important is the data.
Okay.
I mean, the dot plots are important in the sense of what the Fed think, but I wouldn't invest any money on the dot plots.
Okay. So let's assume that it's a normal kind of an economy, maybe a little slowing at the margin, but no crisis, nothing panicky. And you have these rate cuts which have started. Let's just assume it's 50 now and then maybe another 50 through the end of the year. What does it mean for asset classes like equities?
Well, it's good news it should be good news for emerging market equities because in most emerging markets, particularly here in Asia, central banks all year had the ability, could have cut rates for their own domestic reasons based on the level of real rates and inflation. But in the vast majority of the cases, they chose not to cut rates because they were worried that they might undermine their own currencies. And in the specific case of Indonesia, which has a currency, the central bank has a currency stability mandate, they actually raise rates despite very high real rates. So basically, all these central banks will now have room to cut rates, and hopefully their currencies don't get hit. So far, basically, the dollar has been in an increasingly clear weakening trend. Yeah, so that's basically good news for emerging markets.
So EMs more than US?
In my view,
in
yes.
an easing cycle?
Yeah, in my view, yes. Because in the specific case of the US, the interesting point is how resilient the US listed companies have been to the Fed tightening cycle. And that is explained by this extraordinary statistic that the net interest payments of the US non-financial corporate sector have declined sharply in this Fed tightening cycle, which is counterintuitive, but it's the reality. And that's because the big tech companies have been earning 5.5% on their cash, but they used to earn 0. And it's because the investment-grade corporate sector in America did a very good job locking in bond yields when they were low, refinancing their debt. So if the higher rates actually were positive for them on the out, where the lower rates will help is the SMEs, because they don't issue bonds. And that's the big surprise. SMEs in America have been paying between 9 and 10% to borrow money for the last year. And that's why I'm genuinely surprised how resilient the labor market has been. Yeah, because they employ most Americans.
What about India, Chris? I mean,
well, in the case of India, the RBI can cut rates like
later this year.
All Asian central banks can cut rates today, including the RBI. But my colleagues here, we believe the RBI is not going to be aggressively cutting, i.e. the RBI is going to behave in a different way from the Fed. And actually the RBI in recent months has been actually counter-cyclical because they've been doing these preemptive regulatory measures as regards the banking system. And so I would assume the RBI will cut rates once before the end of the year, but I could be wrong.
Okay.
And they can cut rates because...
That's the consensus. First cut by December of this year.
I think the RBI would be coming under criticism if they haven't cut rates by the end of the year, because if you look at the level of inflation, particularly core inflation, is below the level of rates. So you have positive real rates. But obviously with the stock market at all-time highs, huge domestic flows going to the stock market, the RBI doesn't feel under massive pressure to cut rates today.
Yeah, absolutely. Chris, what about flows into India? Because the market here has been marching to the sort of drumbeat of local investors putting in money, and that number has sharply increased. It's about $4 billion regularly a month coming into mutual funds. It was about $2 billion a month before elections. So actually post-elections, the number has gone from $2 to $4 billion a month. I remember you were surprised when the market here, barely shrugged in response to the election.
That was a big surprise. That was a big surprise to me.
And of course, after the capital gains...
well, that's actually the biggest surprise to me was the second.
Yeah.
So after the election, clearly it was only one-day sell-off, but then I think the market's reaction was explained by the fact when I came to Delhi shortly, it was clear that everybody believed this government could last 5 years with the two minority parties. So that became more explicable to me. But I have to say I'm genuinely astonished by the resilience to the capital gains increase, which is quite material, most particularly as the week before I met many domestic institutional investors and they were not expecting the capital rate gains tax increase. So I find that...
and many of them were very vocal that markets will be hurt.
Yes, I would have been too. So we've all been completely wrong. So the only explanation is that the domestic households who are investing through these monthly installment plans have become convinced, in my view correctly, that India is a good long-term equity story and don't want to be scared out of the market. That's the only... And the big story of India this year is these domestic flows.
Yeah. But what about foreign flows? You said that easing cycle is great for EMs. India is an emerging market. Foreigners have stayed away.
But on a relative basis, if you're investing, if you're an EM fund manager, after this 50 basis point rate cut yesterday, the markets you're going to want to add positions to are places like Brazil, which have 11% nominal rates, 5-6% real rates, so huge potential to cut rates. Markets in Southeast Asia, like Indonesia, Philippines, which are traditionally very sensitive to lower US rates, weaker US dollar. So India is not the obvious place to put your money in today because, one, it's expensive, and two, the RBI is in no hurry to slash rates.
Well, Chris, stay with us. We'll take a quick break here. Stay with us because we got a lot more ground to cover with Chris Wood of Jefferies on the other side.